So I'm going to walk you through exactly what I found, the assumptions I used, and why the obvious choice might actually cost you more than you think, or at least why it's not as obvious as it looks on the surface. Here's why I'm even asking this question. A mortgage recast is not the same thing as refinancing. You're not changing your interest rate. You're not extending or shortening your loan term. You're not filling out a new application or going through underwriting. What you're doing is making a lump sum payment toward your principal and then asking your lender to recalculate your monthly payment based on the new, lower balance. The interest rate stays exactly the same. The payoff date stays exactly the same. The only thing that changes is your monthly payment drops because you owe less principal. Most lenders charge a flat fee to process a recast. It's typically somewhere between $150 and $500, depending on the lender and the size of the loan. For the model I built, I used $250 as the recast fee because that's right in the middle of the range, and it's what my lender quoted me when I called to ask. So in the recast scenario, you're paying that fee upfront in addition to whatever lump sum you're putting toward the principal. The alternative is dead simple. Or your car dies, and you need $5,000 for a replacement. Or you have a medical emergency. Or your kid needs braces. Or any one of 1,000 things that happen to real people in real life. What happens to your $2,100 mortgage payment? It doesn't care that you lost your job. It doesn't care that you have $10,000 in VOO. It's still due on the first of the month, every month until you find new income or you start liquidating that brokerage account. Now, let's run the same scenario in the recast world. You're 3 years in. You recast the mortgage 2 years ago. Your payment is $2,020 instead of $2,100. You've been investing the $250 a month into VOO just like in the other scenario, so you also have about $10,000 in the brokerage account. You hit the same emergency. You lose the same job. But now your monthly payment is $80 lower. That's $80 a month in breathing room. Over 6 months of unemployment, that's $480 in cash flow you wouldn't have had otherwise. It's not going to save you by itself, but it's something. And when you're in a tight spot, something is better than nothing. This is what I mean when I say the recast buys you optionality. It's not just about the return on paper. It's about the flexibility you get when things go sideways. And if you talk to anyone who's been through a real financial crisis, they'll tell you that flexibility is worth more than you think it is when you're building these models in a spreadsheet on a sunny afternoon. The other thing that doesn't show up in the numbers is the psychological side of this decision. I'm not talking about feelings in some vague, hand-wavy sense. I'm talking about the actual behavioral reality of how people interact with their money over long time horizons. If you recast your mortgage and your payment drops by $80, that $80 feels like found money. It feels like a win. You're more likely to do something intentional with it, like invest it, because you've already made the decision to optimize your mortgage. You're in optimization mode. You're thinking about this stuff. But if you skip the recast and you just tell yourself you're going to invest $250 a month into VOO for 15 years, what actually happens in month 37 when your dishwasher breaks? Or in month 62 when you want to take a vacation? Or in month 90 when you're just tired of being disciplined and you want to spend some money? The $250 a month isn't automatic. It's not coming out of your paycheck before you see it. It's sitting in your checking account, and you have to manually move it into your brokerage account every single month. And every single month, there's a decision point. There's a moment where you could spend it instead. I'm not saying you will spend it. I'm saying the temptation is there every month for 180 months. And if you slip up even a few times, if you skip even 3 or 4 months over the course of 15 years, you've just erased a big chunk of the advantage that the straight to VOO scenario had on paper. The math only works if you're perfect, and nobody's perfect for 15 years. The recast scenario has a built-in forcing function. Once you recast, the payment reduction is automatic. You don't have to think about it. You don't have to make a decision every month. The $80 just shows up in your budget, and if you've set up automatic investing, it goes straight into VOO without you touching it. There's no decision fatigue. There's no temptation. It just happens. Now, I'm not saying the recast is better because of this. I'm saying the behavioral side matters, and it matters more than most people think it does when they're running these comparisons. The 10% average return I used in the model is just that, an average. The S&P 500 doesn't go up 10% every single year. Some years it's up 30%, some years it's down 20%. And the order in which those returns happen matters a lot when you're making monthly contributions. If you start investing in VOO right before a bear market and the market drops 30% in year one, your early contributions are buying at high prices right before the drop. You're underwater for a while, you eventually recover, but you've lost time. If you had recast instead, you'd have locked in that 3.2% interest savings immediately, and you wouldn't have been exposed to that drawdown at all. On the other hand, if you start investing right before a bull market and the market rips up 25% in year one, your early contributions are compounding at a much higher rate, and the straight to VOO scenario pulls way ahead. The point is, the outcome is path dependent. It's not just about the average return over 15 years. It's about the sequence of returns you actually experience, and you don't know what that sequence is going to be when you're making the decision today. The recast gives you certainty. The market gives you upside potential, but it also gives you downside risk. If you're someone who can handle that risk and you've got the time horizon to ride it out, the market probably wins. But if you're someone who's going to panic and sell when the market drops 20%, you're better off with the recast. Let me also address the opportunity cost of tying up $3,000 in the recast. Some people hear $3,000 up front and they think, that's $3,000 I could have invested on day one. And that's true. But here's the thing. If you don't have $3,000 sitting around right now, you're not actually giving up that opportunity. You're going to have to save it up either way. And if you're saving $250 a month, it takes 12 months to get to $3,000, whether you're saving it to recast or saving it to invest. The opportunity cost only exists if you already have the $3,000 in cash and you're choosing to recast instead of investing it immediately. If you're starting from zero, the two scenarios are a lot closer than they look. You spend a year saving up $3,000, you recast, and then you start investing $250 a month. Or you spend a year investing $250 a month, and then you keep investing $250 a month. The first scenario is delayed by a year, but the second scenario doesn't have the payment reduction. It's a trade-off, and the gap between them is only about $4,000 over 15 years at a 10% return. Here's my personal take on this, and this is just my opinion based on my situation. I'm leaning toward putting the money into VOO. My mortgage rate is 3.2%, which is low. My income is stable. I work a salaried job with benefits. I've got an emergency fund. I've been investing consistently for years, and I know I'm not going to skip months or dip into the brokerage account when things get tight. For me, the extra $4,000 in expected return over 15 years is worth more than the $80 a month in payment flexibility. I'd rather have the higher compounding potential, and I'm willing to accept the volatility that comes with it. But if my situation were different, I'd make a different choice. If my mortgage rate were 5%, I'd probably recast. A guaranteed 5% return starts to compete with the market on a risk-adjusted basis, especially when you factor in the payment reduction. If my income were variable, or if I were self-employed, or if I didn't have a solid emergency fund, I'd probably recast. The $80 a month in breathing room would be worth more to me than the potential upside in the market. If I were older, or closer to retirement, or if I just didn't want to deal with market volatility, I'd probably recast. The certainty and the lower fixed costs would give me more peace of mind. And if you're on the fence, the gap is small enough that either choice is defensible as long as you're intentional about what you do with the money and you don't let the $250 just disappear into lifestyle creep. If you want me to run the numbers on a different rate or a different time horizon, drop it in the comments and I'll see if I can model it out. And if this helped you think through your own situation, hit subscribe. I'm doing more of these side by side breakdowns on real financial decisions, not just macro headlines. Thanks for watching. I'll see you in the next one.